Ready for tomorrow?
I am.
All right, have a lot of coffee. All right, everyone, of course, is waiting for tomorrow with bated breath, this jobs report. Now, I think consensus probably moved a little bit lower after that ADP report. Coming in, it was around 160. I guess we'll hear at the end of the day it's 150. Meanwhile, though, check this out. Bank of America is saying, forget about it. They're looking for 200,000. And by the way, they're not the only firm looking for a major beat tomorrow morning. I want to bring in Bianco Research, their president, Jim Bianco. Jim, it's almost comical, though, to even have this conversation, right? The initial prints in these jobs reports are revised so much now and so deeply. Nevertheless, it moves markets. So what are you anticipating?
Yeah, I mean, you're right about the revisions. In fact, some people have even argued that even a strong number tomorrow should be dismissed because everybody thinks the revisions go lower. Well, they have in the last few months, but not necessarily in the future. The consensus is around 150 to 165,000. 25 of the last 31 months, I think the number has beaten. I'll go with that. I think that we'll probably see a little bit of a bounce back from the weak number in July, and we'll see it probably beat, and then we'll start that parlor game as to whether or not we're going to wind up revising away whatever gains that we see.
Yeah. And, you know, considering the influence of government jobs, I want to share this. Government spending on this jobs report, government jobs, private education, healthcare, if we strip those away, because that's up here, and you look at the rest of the private sector, it's down here. The private sector is in a lot of trouble. Could Powell and companies sort of say, okay, we're smart enough not to be so over-influenced by private education, healthcare, in these major government areas, and see what's happening in private sector? How could that sway them with respect to the first rate cut?
Well, that's going to be difficult for them to kind of do it because, as we like to say, interest rates are a blunt tool, right? You can't just cut interest rates for certain people and then not cut them for others. But, government, healthcare and education is like a third of the workforce. It's a huge part of the workforce. And if you ignore that, you're also ignoring that the government is spending money like crazy and that might be inflationary as well, too. And if you want to focus on just private jobs that are weakening, then you run the risk of going too far. We got to cut rates a lot because look at how weak the economy is. Well, if the government keeps spending and we keep having more and more of those other sectors like healthcare and government expanding, we could wind up with more inflation. So they should put them together and look at them because they've got a blunt tool. They don't have a fine tool in interest rates and trying to figure out which way they want to go.
Let's pick up on that, the notion of inflation still maybe being in the picture, right? ISM services out today. So we look at ISM services and manufacturing for August. Both of them were up. So manufacturing up 1.1, level 54.9, services up 0.3, services at 57.3. Bottom line is they're both in expansion mode still on the price side. Are we dismissing inflation too early?
I think we are. And I think that, the inflation rate has really slowed down a lot and it's still way too high at around 3%. And in your numbers, that's prices paid. That is the input that these companies get. What is the prices paid input for a service company? It's labor. They're not buying things. They're getting people to work for them. And if it's still at 57, above 50 means expansionary, we might still be seeing some residual labor wages that everybody's convinced has gone away. But except the problem is the ISM services is not necessarily showing that we've really solved this wage labor problem, which could keep overall inflation up and be problematic for the Fed.
All right, I got 30 seconds. What are you anticipating tomorrow from the number and the reaction?
Well, considering that the 10-year yield is down 21 basis points already this week, and that's a big move. I think the market is wound up in a way that it's going to be hard for it to continue to go lower in yield, and that any kind of beat could produce a bigger, higher move in yield. And of course, the stock market won't like the idea for interest rates move up. So I see it as kind of a one-sided risk going into tomorrow morning.
All right, Jim. Hey, Jim, always good stuff. Thank you so much, my friend. Meanwhile, folks, stock markets.